you may not have heard, probably have. Stock market down, right? Sales prices still up, very tough to buy. Rental markets softening, right? So there's a lot of risk right now going on in investing, from the stock market to real estate. So today we brought on a specific guest for this very reason, Patrick Grimes. He's the founder and the CEO of Passive Investing Mastery. And Patrick has an amazing story about bold moves, relentless growth. He left his engineering job to go all in on real estate, started with single family, then went to multifamily, and ultimately he's kind of built a very recession-resistant portfolio across many alternative investments. So in this episode, Patrick talks about his story of burning his boats, where he went all in. He kind of pivoted away from the traditional real estate into different alternative investments like energy, litigation finance, and commercial lending. And his strategy is basically diversifying that thrives even in economic downturns. Sound familiar? So if you're looking for insights on how to recession-proof your portfolio and achieve true financial independence, this is going to be a conversation you don't want to miss. So this is really, really important to listen to. He's got some great ideas, some great concepts, and some great opportunities. So let's jump right in. All right, everybody. Welcome back to another exciting episode of Burn Your Boats Wealth. I'm Clark. I'm here with my co-host, as always, David Shaw. And today we have Patrick Grimes. And Patrick, who's the CEO of Passive Investing Mastery. He's an international best-selling author. And Patrick has joined us today. He's in Hawaii right now, so it's about 5:30 his time. So I want you guys to know his commitment to being able to provide value to you as the listeners today is that he got up at probably 4:30 this morning. So we really appreciate that, Patrick. And to kind of get started, I know, Patrick, you know, the name of this show is Burn Your Boats, right? And you have an amazing Burn Your Boats kind of story with lots of pitfalls and scary moments. And I know a lot of people listening are kind of stuck. Maybe they're in their job, maybe they're wanting to do something, but they don't have that confidence, they don't have the network, they don't have that thing to push them over the edge. Would you kind of start off, before we get into the nuts and bolts of what you do and all these cool alternative investments that you have, kind of talk to the listener a little bit about what that looked like when you were going through that story, when you were going through that journey, and, you know, some of the pitfalls and fears that you faced?
Well, thanks, Clark and Dave. Really excited to be here. Burn your boats wealth, man. I can resonate with that goal because, you know, as we were talking a little bit ago, there's just so many times in my life when I feel like I've made a leap with some uncertainty and at critical times. And those have been successful and unsuccessful, both. But that's part of what makes you, you know, where you are today. I think my first leap was back when I was a machine design, automation, robotics engineer, probably a lot like many of your listeners, just working real hard. I had a bachelor's in mechanical engineering, and I joined a automation and robotics firm, started doing well and making some income. And I asked for some advice, like, where should I invest? And I was assuming, because we were working at medical device, high tech, you know, places like Abbott, J&J, Facebook, Google, Lockheed, Raytheon. I thought it was going to be like, oh, here's this startup, it's a shoe-in, go invest here. And so, you know, most of our business was Silicon Valley too. He says, no, I make all my money high tech and I dump it in alternatives, into real estate. I was like, what? What are you talking about? So it was a really interesting time for me. I took his advice to do that. However, I didn't do it the right way. I lost everything in 2009 and 10. It turns out pre-development was not the safest tried and true to sustain wealth building. And so that took me down pretty hard. But, you know, to me, that was like my first leap, I would say.
Patrick, so you're like a lot of our listeners. You know, I've listened to other podcasts of yours. Both your parents were educators. So, you know, education, attainment, obviously was a really, and still is a really big part of your story. And so my understanding is when most people have academics as being their skill, they risk tends not to be part of that. and I don't know if that's fair to say that academics and risk don't really go hand in hand. Academic people, by and large, tend to have an academic route through their lives. They're highly employable, they're highly sophisticated people, and they tend to not really need to take risks. You actually have a very strange blend of an incredible academic journey and a W-2 employee journey, plus the risk side. Can you start off with the academic side? Like, what is your academic achievements? And then what were, these W-2 achievements? And, you're talking to somebody, they're talking to you about, investing in alternatives. Can you talk to us a little bit about those three things real quick?
Sure, it's true. My father has 3 doctorates. My sister's a PhD. I think I'm actually not the well-educated one in the family.
Wow.
I've got a bachelor's in mechanical engineering, a master's in engineering, and MBA, and I'm the underdog.
Jeez.
Wow. Anyways, it's not that it's competition, but my sister does remind me that 2 master's degrees does not equal 1 PhD.
That's very funny, Patrick.
But my general sense was, I just came from kind of a desire to learn. I've always had that passion, whether it's academics or it's hobbies. I even learned how to. My first job out of college was working at a winery. I worked for Ernest and Julio Gallo's largest winery in the world out of Livingston, and they have 3 there, Modesto in California, the second and third actually, and 150 million gallons capacity of wine came rolling through, crushed out of that winery in one crush. It was a huge plant, and I was there learning all about wine, getting real passionate about it, and then I learned how to brew beer by the people that worked there, and obviously I've been brewing beer ever since. But I tend to deep dive into things that I'm really excited and passionate about. And I tend to bring people along with the journey. And I mean, 12 years before COVID, I took a charter bus of friends up to the Sonoma area for their barrel tasting event on my birthday every year. I've always been that kind of guy. And, whether it's, wine or beer brewing or traveling around the world, I've always wanted to kind of share those experiences. But so the education was always kind of a drive, for me, balancing kind of that education, kind of that outdoorsy adventure and hobbyist kind of sides. After I kind of lost everything in real estate, I circled back. I decided, look, I'm still a successful mechanical engineer. I financially needed to recover, credit needed to recover. So I doubled down on my career, and that's when I got the master's degrees and was a bit bigger fish in the pond. And I started doing really well at single family in a not kind of speculative free development, but buying existing assets for cash flow. And that was an education too. I downloaded books. I run it every morning, by the way, including a short 30-minute run today before this. I was here on 5 a.m. for you guys. But we have the beach here, and I listen to podcasts, whether it's your podcast, like the perfect podcast, is inspirational type stories, TED Talks, audiobooks on investing, self-help. Now I'm listening to a bunch of audiobooks on how to raise a 2-year-old. And so,
yeah, right.
But I start the day with education, and that's really, part of who I am. And that's why we have Passive Investing Mastery, which is a platform purely for educating investors on what alternatives to invest in. But what kind of set me up, I think, is that I was humbled early through, just the trenches, taking grenades. I learned how to do things more, recession resilient, be more patient, the tortoise, not the hare. And that was really, I would think that was really the kind of kept me going.
What, Patrick, you mentioned before we hopped on here is that you kind of lost it all in 2009, right? And I think that there's so many people that never get out of the gate because they don't want to, quote unquote, lose it all. And it keeps 99% of the people from ever even taking the first step, even stepping up to the plate to swing the bat, right? Because they're like, what if I swing the bat and I miss and I fall on my face? Well, you fell on your face. When you've got this family with all this high education. I can only imagine that they're like, you're crazy for going out and doing this type of, speculative real estate and everything. You've got your relationships, probably your friend networks, especially if you were in the engineering field. You're probably surrounded by a bunch of colleagues that think that you're bonkers to do that. When they put all those fears onto you, and then it came true, right? 2009 comes and it actually came true right out of the gate. What was it like going through that? What were those discussions like when you were having those talks with your family? You're sitting at the Thanksgiving dinner table. Walk us through how challenging that was, and maybe some things that you kept you going when you got up in the morning.
Well, I didn't have a family when I lost everything in 2009 and 10, so it was just me.
Okay.
And it was a bit scary. I had talked to some attorneys. I couldn't actually even get a hold of the lender because they had bought and sold my notes so many times as they did back. And then
Oh,
they wouldn't take the deed in lieu. They, in fact, they were quite hostile when I did hire an attorney out in the area that helped me with the closing to actually find who it was to talk to. And they were quite hostile on the phone. And so at that point, the attorney said, you got to stop paying, because I was a bit naive. I didn't want to go through foreclosure. I wanted to own up to my debts. And
yep.
I realized it's so far upside down. There's simply no way. And then the attorney just said, if you want to get their attention, you have to stop paying. And so that was frightening for me, because I had never not paid a debt, and I still haven't. I have I think I have a perfect credit right now.
Yeah.
Because after, 7 years, the foreclosure dropped off. Right. So, then going through the whole process was really nerve wracking, because it was the first time I'd played with these kinds of numbers. And then also I was a bit surprised, because on the back end, the lender ended up doing a component of debt forgiveness through the foreclosure process. The government then 1099'd me for
the difference. Yeah.
air quote debt, right? And so then I had tax implications that I was paying in the subsequent years. That all was pretty brutal, and I was battered and bruised. But by the way, I also know how to have a good time in life. So after I just dove into I think for a couple of summers, there was one summer when I went camping 18 times in one summer. Just
Wow.
I'm an outdoorsy guy. My parents. I spent my formative years on the south side of Yosemite National Park. And then when I finished my master's degrees, before I started kind of in a bigger fish, smaller pond, I traveled through the Middle East and Asia. And when I graduated, I traveled through Europe. So I had a lot of time to kind of reset, recenter, and be ready for the next kind of phase. And I kind of have it. Then I went on a sprint, right? I bought a bunch of single family, and I'd say the next burn your boats moment was when I realized that single family is not going to get me there.
Yeah.
Because when I started hitting it hard, it was working. I mean, I was buying properties, had a team set up in Texas, and were recession resilient, existing cash flowing assets. It was all my own money. But it was the night. I mean, I was a very successful engineer by day, but I was exhausted, because my side gig, my night job, was this real estate investing stuff. And I ended up stopping when I met my soon-to-be wife. She was there for my last closing, and I just was like, look, I've got to go back in education. Circling back to your comment, Clark.
Patrick, give some context. So you were at your W-2, you're doing the single family thing, like you're doing the night thing, you're doing the day thing. That doesn't sound like a lot of fun. How many single families did you have? What was your kind of work schedule at that time?
Well, I was going into work. So it was, waking up 7, getting into work 8 or 9, and then leaving at 5 or 6. And then I was traveling probably on average 2 to 3 days a week at that time, because I was working with R&D groups. And so it was either in Southern California, Northern California, or the Midwest typically. I think it was to the point where, and keep in mind, I did have a pretty well balanced. Like I was still like whitewater after the Grand Canyon. I spent 21 days doing the Mirror Trail with my dad. I've hiked Shasta, Fuji. I've been to the base camp of Everest. I was still pretty balanced,
Wow.
right? I did 4 sacred mountains in China. I did 3 14ers in Colorado. I was still doing a bunch of fun stuff, but at the same time, like when I was at home, I was constantly working. So I told my wife, I was like, look, we're going to go get married. but I can't do this anymore the way I've been doing it. And there's really two components. There's one component that I talk about a lot, and that's, hey, look, single family is just never going to get me there. I'm never going to get to the 40, 60 that I need to really retire and survive. And you won't want to be around me that anymore. The other component that I don't ever talk about was the burn your boats moment when I said, look, I can't be a W-2 and do this. I need to become a contractor, a remote contractor. And that was a tough thing for somebody that's been a W-2 their whole life. I remember telling somebody, I've always been on the team. I've always been in the team. I've never been the outsider coming in as a contractor. And I've always viewed contractors coming in as like, they got their own thing going on. They're really not looked out for to the same amount that the employees are. And they don't get all these things that I had at that point. I had never done unemployment. I hadn't done like any of these things that you need, that you get, but you have better protections. And so I think the burn your boats moment was, look, I need to let that go. And so I became a contractor to a company out of state. And now I had much more flexibility, autonomy over my time. I had more time at home with my wife because she was coming home and I was more available. But I also had time to be able to do real estate in a more professional way. And that allowed me to not do single family churn and burn, but scale up to larger apartments. Because once you start working with professionals, they want to work during their workday. Brokers, insurance, all the vendors, they want to talk during their workday. And so that allowed me to move times around during the day such that I could make both turn out. And then what I told my wife is that back to the education comment, learning how to do larger apartments was like my third master's degree. because she was like, well, I mean, you're going away nights and weekends, but this time we actually have something that will scale, right? And so I was spending nights and weekends going through all kinds of boot camps, downloading books, going through workbooks, learning underwriting, on mastermind channels, and learning how to analyze properties. And she was traveling with me and she was having fun with it. In China, though, they don't. She's from China. They don't really, they don't really honor entrepreneurship there. In fact, it's the opposite, right?
Yeah.
So it was big gap. And I think that the other thing that the burn your boats moment that I don't really tell people about is that when I made that switch from W-2 to contractor, at that same time, we were actually getting married, and her parents in China, we did not tell that I was, quote, at that time, unemployed. We actually tell them because she's just like, it's probably just better. And the whole conversation about being an entrepreneur, that was a conversation that went over years. As a contractor, they weren't necessarily comfortable with. They weren't comfortable with that. And so, and neither was my wife. Actually, it took quite a while. We went to one camp where she finally got it about the possibility, and she came home, created a vision board, and got on board. But it took a while. And I think then when I succeeded at real estate, and larger apartments, that's when I think I probably burned the last boat, right? That I burned, which was the contractor job, the 1099.
Here's a couple of questions for you. When you're doing got your W-2 and you're buying in Texas, you mentioned one thing, and a lot of our listeners will want to know the answer to it. You said it just can't scale. Quick question. How were you buying? What was your strategy? And why can't single family scale?
I was doing the BRRRR method before I knew what the BRRRR method was. And I had just downloaded books and worked with, people. I just started, that's what I was doing. And my strategy was mostly I created a team, met a bunch of people in Texas. Actually, one of my high school friends moved out there, so he's helped me get some connections out there. For renovation, I found a couple hard money lenders that would roll into Fannie Freddie for long term. I bootstrapped it. I didn't have a coach. I just figured it out, right? And it wasn't any harder really than doing designs on my day job, quite honestly.
So Patrick, you're out in Texas and you realize, the single family BRRRR method is just super sticky. It's super hard to scale, but you've achieved a certain amount of success there. What was it that made you make the decision, you know what, I'm going to do multifamily? And, you know, again, I've listened to other podcasts of yours, and I know you became a very successful, you know, multifamily person whilst you're 1099 in your career. So tell me, why do you think it wasn't, why it's so difficult to scale a single family portfolio, and why a multifamily portfolio is so much easier?
Well, so I contribute to Forbes. So there's probably a dozen articles. If you write Patrick Grimes Forbes, and there's ones I've written specifically on why single family versus multifamily in terms of scaling and in terms of asset protection and in terms of even using your retirement account funds more effectively and efficiently. And there's just my rate of reasons. We could do it. We follow podcasts that I could just go into the nitty gritty. But in general, it becomes a big challenge, not only in terms of uh, of when you buy properties, it takes about the same amount of time to buy a single family home. Is it
Yep.
just to give you some comparisons? In my calculus, the best assets in America when it comes to real estate are 3-bedroom, 2-bath residential, and that's, if you look back, those are the ones that sustain their value and bounce back the most. Okay, and then all the way to 80 plus units in apartment buildings, and so you go to commercial. And so the challenge is once you get to 80 plus units, you have on-site leasing and maintenance. So you're not chasing around a property manager to go from site to site. It's, you have somebody on there reporting to you full time. And that's a completely different lifestyle change if you
Yeah.
and from investment control. And you can have your own people working for you, looking after you. Also, the debt products are entirely different from
Yep.
you know, residential, and where you essentially can't, it's very difficult to get away from the personal guarantees. The property manager is extremely expensive as a ratio of your
Yep.
rent, and the ratio of vacancies is a pretty big dramatic hit, right? And so once you get 80 plus units, you can get non-recourse agency loans that are even interest only for long periods, and then amortize. You can get far superior debt. And so I don't think 80 units is where you want to live. Just happened to be that that's where the calculus in the majority of the locations in the United States, you have to get above that for it to make sense for you to get the better debt, to get in the combination of the on-site management. So you're not constantly chasing a property manager and vendors
Right.
around. And you can get economy of scale in the renovations, where every single time I was having to scope different renovations for every single asset with a whole new story of each property. And it's a huge endeavor every time. Whereas you buy it one, you go due diligence on 80 or now 300 or 600 units in some of the buildings, but you can just show up and you can go unit to unit to unit, and you can do it all, and you can figure out the similarities. You can have one group of vendors go to each one, and then you can then have a reno team just go from unit to unit to unit,
Yeah.
and then do this at scale. And so it is a far better. And not only that, but then the way you can force appreciation with single family, you're basically if you're trying to improve a property, and the other properties are selling for less square footage than you're going to be brought down by that because they're sold based on your square footage. And then larger multifamily, it's not the case. It's a business, so they look at a multiple on revenue.
Right.
And so if you put money in to improve the asset and you rent for more, then that correlates to value gain more directly. And so it's just the calculus is just so much better when you look at larger commercial. Now during COVID, of course, you had a bunch of challenges that shook the industry quite a bit, which is another conversation we can have. But at the time, and even today, you see far better advantages when it comes to not only the scalability and efficiency, but also the asset protection. Most people own single family in their own name. I don't think what they realize, which I have a whole article, Patrick Grimes, single family asset protection, is that you're really kind of betting it all, right? Each time you do that, because the lenders, they're just not good enough assets for people to want to invest with favorable lending terms and LLCs. Or people are trying to buy it in their own name and then swap it out, right? Where you risk calling the loan due.
Yep.
And nobody does that, right? Well, it happened to me in 2009 and 10. So that's not a valid, and it's just not a sustained, responsible way to grow and build your wealth. And it's really difficult to diversify it, not only geographically, because now you're in one city, you maybe have concentration, but you're running all around. It's really hard to manage. But you want to be in various different geographies, right? Without a scale in each one, you're not really diversified geographically. So there's just a myriad of reasons why single family will just wear you out. And you'll find yourself, I found myself just sacrificing family, friends, and hobbies and the causes I care about most on a regular basis, and risking not even being able to marry the woman that I'm now married to with our 2-year-old boy because it was such a hassle. And to answer your question, Dave, what's on the other side? The other side is a world where I learned to partner, right? I learned to work with people that had been doing larger apartments for decades, had a track record, lived in certain markets nearby that instead of kind of putting my personal credit and my own name behind each loan in single family each time, we were to buy them in LLCs, right? And you're able to do non-recourse loans and things that provide more sustained, longer term, resilient, protected wealth building strategies. And as an investor that's like, hey, should I put 100 grand into buying my own property and essentially leverage the cross collateralize, which is what signing, personally guaranteeing something is, the rest of my wealth in the process, or invest 100 grand as a partner into a larger apartment building with a limited partner where I'm limited in losses to that amount. That's not risky at all still, right? So there's a lot of reasons why. And our company isn't all about apartments. We're not. We're about alternative investing. And my whole life has been about diversifying in various alternatives. And so we actually promote completely different investments like medical. We have a litigation finance. We do energy. We do all kinds of things to build a more well-rounded, sustainable financial security method where you're not riding one wave of real estate or the stock market. But those same principles of being able to partner with a sponsor, somebody who's an expert in other areas of the country, in other markets, and other industries, apply in this. All those same arguments apply for in the same way that single families bear compared to larger apartments. Larger apartments are just businesses where you can do similar kinds of investing in businesses, but in the medical industry where it's recession resilient, or education where people still need skilling and upskilling in downturns, or in the legal industry where they're just, it doesn't matter. The legal industry just tried and true growth, doesn't give a lick what's going on with interest rates, gold, oil and gas, the stock market. It just goes up. You invest there, you're betting with a house, right? It always wins.
Right. Well, that's why we have you on the show, Patrick, because most of our listeners are single family home investors. Many of our listeners are. And that was a great response. If anybody has ever questioned why people graduate and evolve, if you will, into multifamily, Patrick's just laid it out right there. Now, Patrick, we're going to pivot right here into what's going on right now in the marketplace. It is March 25, and there's a lot of turmoil, political, global, in the equities markets, in the economy in general. And so most, I would say, middle class wealth is invested in their primary single family home, maybe a couple of investment homes, and a large amount of folks' wealth is invested in the equities market, and that is what their financial advisor will have advised them to do, right? Because a financial advisor obviously has his products that they can sell, and yet you're in this alternatives world. I'm going to ask a couple of questions. Multifamily, for all its benefits, to your point, is also valued based on cap rates. Now, when interest rates rise, cap rates will go down because the debt input is that bit more expensive. And so how have you ridden this higher interest rate environment across your portfolio of multifamilies? And then I'd like to talk about these, because everyone wants to hear the rest of this conversation, which is alternatives that are not correlated to higher interest rates or the economy at large. So then we'll get into that. But for right now, how is your portfolio of multifamilies navigated the last 2 or 3 years of higher interest rates? Just answer that question, if you will.
Well, I'll tell you what, nobody's immune to interest rates when you're in real estate. And that's
That's
the
right.
heart that you want to be a well-diversified, non-correlated portfolio, like the wealthy. Hedge funds and sovereign funds are all that way. Why not you too? But there's a couple ways that we can look at it. For the most part, any asset where we got to kind of back up a little bit, because it wasn't just interest rates that hit commercial real estate. In fact, the reason why we have two opportunistic funds right now to take advantage of the downturn in commercial real estate, both debt and equity, is because this is like the most unique time to either lend or buy commercial real estate.
Yep.
Not just because of interest rates, or else interest rates would be high and things would be bad, right? But there's a lot of other things that happened. During COVID, we had the eviction moratorium. Like, holy crap, what is generations? And like, I look back, like we didn't have that. We didn't have an eviction. In other words, people who owned apartment buildings were able to charge rents. And so what happened there was a couple things. One is it destabilized the ability to make income. Imagine, if you will, the corner store, which is essentially what our apartments were. They were, 800, 200, 300 unit apartment buildings on the corner. Imagine you the corner store. Hey, by the way, we're not going to, the community here, they're going to come in each day. They're going to take a basket of groceries. They're going to go home for an unforeseeable amount of time until we let you know you can't. Right, and you can't evict them or prevent them from coming in. They still get to go into their home. They still get to come in your store and at will fill up their basket of groceries. Holy crap, how could you ever expect?
I remember it, Patrick.
So this is what's going on. And of course, we have lots of reserves, 6, 8, 9 months, but what happened? 6, 9,
it goes fast.
Came and went by. And so that obviously crippled. And so that was one piece. The other piece was then subsequent to the eviction moratorium, they finally lifted it. Well, what did that mean? You had huge backlogs, right? Some places caught up where we could evict in like, a month and a half or a month in like Texas. They caught up fairly quick. It was like 3 or 4. But then some places never, it took years, and we're finally catching up in places like Atlanta. Here we are years after. Atlanta was at 18 months, even post the eviction moratorium. For a significant period, a year and a half. So post the eviction moratorium. So how do you even survive? And so there's huge devastation currently in Atlanta right now. And we have 2 assets there. We are really working hard, to get those back up, but it's completely destabilized the business plans there, and it became more of a capital preservation thing. There's really nothing you can do.
That's right.
About not being able to charge rents for a significant period of time, plus an 18-month backlog. And there's a bunch of class action lawsuits now being filed against the government for not. And there was, there's a whole politically driven thing too. They don't want to put people on the streets.
Right.
So there's all that going on. Like, how is that even a thing, right? How is it you possibly just tell businesses they can't charge rents? Or sell their goods, and people are entitled to it for free?
It was crazy.
Then there's this other piece where inflation, right? Payroll and materials went up. So our original budgets, which were mostly consumed just keeping the property afloat, not being able to renovate because people aren't paying, but they're not going up. We can't get them out, right? So all that happened, and then our budgets are now much higher for the payroll and the construction costs. But even that's not really the biggest hit. The biggest hit, short of the interest rate, was insurance. Insurance doubled in some markets, and insurance was literally the second biggest expense to taxes, right? And insurance 20-30% increases, not in the Midwest portfolios, we're actually doing okay, but in most of the southeastern states in Texas, where you see more landlord-friendly, favorable flocking inbound migration of people, where it's the best markets to invest in for decades. Those are, and because of the insurance carriers just picking up and leaving, right? And so the problem is so many natural disasters. So you've got this like perfect storm where you were able to put like very conservatively 4 or 5% growth in insurance, And now you're looking at 20% a year for 2 or 3
Yep.
years. In some places it doubles. Some like if you're in Florida, which thank God we had sold everything for a sizable profit in Florida prior to COVID, but in Florida you may not even be able to get insurance. It's like insane. And so, which has major effects on lending. But anyway, so there's this huge destabilization. It's been very difficult. It's been, a very hard year. Look back generations, nobody had to deal with this, right? In multifamily. But we're working very hard right now on a daily basis to make sure that we're selling some assets at a big profit. Like we're selling one of my first multifamily deals, at a 1.7x for our investors, which is great. And
Fantastic.
then some in some of the more non-favorable markets like Atlanta, we're working to get, 80, 90% occupied, making sure that we're working on preservation of capital, right?
So, Patrick, you've got rental moratoriums, you've got long delayed evictions, you've got inflation, insurance doubles. There's got to be another answer, my friend. So, I heard you say earlier, I heard something that was like, this investment is not correlated to interest rates. So, let's dive right into that because I think that you've just described a lot of people's experiences, whether they own 2 single-family rentals or 200, apartments. Everyone's being impacted by insurance and if you had to evict tenants and then having that backlog, right? So with the alternative investments that you have, I'm super interested in your litigation as well. When people think of investing and kind of into real estate, it's just kind of like, okay, do I invest in single families or is there a syndication that has a 300 unit apartment complex? There's a ton else out there in terms of options that they have. Talk to us a little bit about some of the different investments you're working on that are in alternatives. Maybe give some tips as to where do you point the fire hose? Like, is there kind of a filtration process that because you have different investments, different strokes for different folks, right? There's not one perfect investment across the board. So kind of give the listeners a feel for what it is that you have to offer. And then also to kind of a filtration as to where they should maybe spend a little more time looking at.
Yeah. Well, first of all, I'm not a financial advisor, accountant, or legal, so I can't give finance, tax, or legal advice. But when I typically talk, and I love talking to investors. It's one of the things that I love to do in this world. I used to go into facilities and meet some of the smartest people in the world, and knock our heads together to come up with unique and creative automation and robotics solutions for things. And so now I get to do this with people on a regular basis who just set up meetings on my calendar, and I can have these conversations to talk about where they're at in their life, where they want to go, and the options that I know and that I'm aware of. And it really came down to, a couple of years ago, I was still, even just a couple of years ago, I was trading the baseball cards of like these alternative assets, these alternative investment strategies, with just a couple other dudes. And nobody knew about these things. We're like, well, how do it was just like who you know and who you know and who you know. And so this platform we have, Passive Investing Mastery, we host every 2 weeks, completely different alternative strategies every 2 weeks.
Wow.
And 3 or 4 people, and we have every single time a completely different thing, which is so awesome. And we do as much of a deep dive as we can live with everybody asking questions, and we right there in the chat, and we have this great banter of different experienced people doing these alternatives. And so I decided to just not just show my hand, but show the whole deck, right? And get it all out there, Blue Ocean approach. Because I wish when I was a hardworking professional, I had that exposure to all these other options, not just real estate. Because real estate rides a wave. I've seen 2 of those now in my lifetime, right? The stock market most certainly rides a wave. So to your point, what I say is people like put a pie chart together, put in that pie chart where your money is, and then figure out, do you feel comfortable about the stability of that, or do you want to add another slice, right?
Yeah.
Of somewhere else where you can put some funds that aren't driven by the same market fundamentals of your current investments. And that's how hedge funds, sovereign funds, private equity funds look at investments. They want to see the ability to invest outside of their current portfolio so that they build more resilience. And that's how you build true financial stability. It's foundations in different markets, right? And that's what is important. It's always been my goal. The challenge is when you get really good and comfortable at something, you get way over indexed in that one thing. And it's that comfort of doing that, which actually creates the fear in the back of your head. But what if this one thing falls apart? And so to build that sustained, more peaceful, go to bed at night knowing you've got, a piece in precious metals over here. You've got something in the medical industry. You got something in the legal industry. You got something in energy. You got something in real estate. And you got something in the stock market. And like, hey, look, we're getting closer and closer. It's a never-ending journey, closer and closer, more well-balanced allocation strategy. So to answer your question about like how you find these things, well, you got to kind of look at like, okay, what industries are recession resilient, right? What industries, in other words, there's less correlated that aren't driven by the same things that drive the rest of my portfolio. That could just be stock market, that could be stock market real estate, that could be stock market energy. And we have whole presentations where I talk about, they show graphs of things like the dollar versus the gold and where precious metals might have a position in your storage of wealth, and how here's oil and gas and gold. Actually, they 80% of the time trend together, right? So those are actually 80% of the time correlated. And how the real estate, single family versus multi. And then I've written whole articles in Forbes on how the ruse of REITs and how REITs actually are directly correlated to the market. So you need to be in the underlying real estate asset. And how medical, education, and legal don't care.
They don't
care. They're just going to trudge along. And so you look at those ones that are recession resilient, that are non-correlated, they don't rise and fall with the rest of your portfolio. My favorites are, in fact, the legal industry and medical. There's also other ones, like if you want active businesses like CPA firms, plumbers, and HVACs, those are also very strong versions, right, of allocations you can make. And we happen to have projects ongoing on the side in many of these, but on our website, we actually have a litigation finance fund. And it was like 3, 4, 5, I can't remember how many years ago I first learned about this. And I was like, this is very interesting. Because when you find an industry that's so stable, that just steady growth, tried and true, like I said, you can bet with the house. It doesn't matter, right? You'll be doing great. You got to figure out how to get access to that industry. And how to profit, and really that's about how can you serve the people in that industry. And although the legal industry is like as big as the global airline industry, it's much simpler. And the global airline industry is this, and I did a bunch of work there. There's like 5 tiers of bills of supply chains leading up to large, very challenging assembly projects. It's about 1 million ways to invest in the airline industry, including buy a plane for cash flow and pilot education, which were featured in one of our mastery series sessions. But in the legal industry, it's hourly rates, right? It's court fees, filing fees, expert witnesses, and payroll, right? There's really not a lot there.
Yeah.
And how do you serve attorneys? Well, there are some attorneys who have clients that can't afford their hourly rates, right? And so those are either pro bono for free, or they're on contingency. And the contingency fee means, okay, you got a great case, I'll take it, but can you sign an agreement that we'll go halvesies, or I'll take 40% of the proceeds, and I'll just.
Right.
So then this allows them to represent those who otherwise couldn't. And so we have a diversified litigation portfolio, which lends to attorneys in the same way that our real estate debt fund that does commercial real estate, not residential, lends to real estate operators. And in the real estate side, we're providing financing. It's an asset-backed lending strategy so that they can acquire properties or CapEx to improve properties and provide housing to tenants. And just like any asset-backed lending, we have a lien, we have security agreements, we have collateral, we have valuation, and we have loan to value, and we have operators with a track record. Just like in any asset-backed lending, we lend to attorneys. We're going to evaluate their collateral with valuation specialists. We're going to do a loan based on that collateral. We're going to put a security agreement in place. We're going to put a lien, UCC1 lien against the assets. And then we're going to lend to either allow them to acquire clients or claimants in their case, because they're contingency fee-based people that have a claim to something, to increase their docket size, the amount of people they have that they're representing, to either acquire them or help them with operating expenses, not CapEx, but operating expenses to get them across the finish line settlement, so that they can provide access to justice for those that otherwise couldn't afford it.
I get it. I think I understand this. And just to simplify it, somebody comes to a lawyer, they've got a $10 million potential claim for a fall, a trip, an accident. Let's just call it, let's make it simple. But they've got this might take 3 years because they're going to take on McDonald's. All right. So they don't have the money to continue to pay this lawyer. So the lawyer said, I'll tell you what, I'll do it at a 40-60 split. So the lawyer is going to get 40% of that $10 million. So that's $4 million. And of that, the lawyer is probably going to need $1.5 million just to bring it and get it all done with the research and all that kind of stuff and court fees and blah, blah, blah. And so you give them, what, half of that, like 700 grand. Then they can take on the case. Takes 3 years. When the case pays out, you pay out. Is that it? Or is it just ongoing monthly repayments?
You got really close, right? There is no, when you're providing access to justice for those that can't afford it, they're not paying steady Eddie cash flow, unlike tenants, which pay steady Eddie cash flow.
That's right.
So we are putting up the capital to enable contingency-based representation. I'll just tweak a few things. We do look for skin in the game, as you said. We don't lend to all. Sometimes they already have people on their list. We'll take that as collateral. So take their existing assets as collateral, as essentially skin in the game. It's kind of like saying, hey, if you can't, Mr. Real Estate Operator, if you can't put a down payment here, then this other building, we want an ownership position over this other building to compensate for that. That's essentially what that is, right? Those are similar games that lenders play, right?
So what happens, Patrick, when McDonald's, you go 3 years and McDonald's just has too many attorneys and they end up winning and there is no winnings or to the claimant?
Yeah. So this is really cool. This is the fun part. So if you look at any kind of investment, there's like a spectrum of how you can invest. There's the Patrick Grimes snot-nosed engineer pre-development, where you could maybe double, triple your money and lose it all, right? And be wrecked and destroyed. Or there's the very late staged existing house that is cash flowing you can invest in, and you can take a much lower reasonable tortoise not the hare return. In the world of real estate, that obviously exists. There's people out there trying to found the new Vegas, right? And there's people out there buying tried and true assets. And same thing in lending. Same thing in oil and gas. There's wildcat drilling, or there's investing in producing wells, right? And equities, venture, there's seed funding and angel investing where you could get 30, 100x returns. And there's investing in the stock market or dividend stocks, right? So in our diversified litigation portfolio, there's a couple nuanced things you got to understand about the legal industry. One is 90% of civil cases settle. It's very litigate already. So that's one thing you got to think about is that. Secondly, there is in fact these opportunities to invest for 100x returns, like there are in angel and oil and gas. But we don't do any. I don't do any of that. I'm super over all of it.
Me too.
I'm not here to do any of that anymore. Like I said, I'm okay with losing a button, but not my shirt. So we're what we call really late staged, right? And we don't do the onesie twosie type one dude against the Goliath. We'll do in all of our cases, mostly we're aggregating lots of different kinds of claimants together, where we're lending to attorneys that are aggregating claimants together. So there's either cases that are way late stage where they've already demonstrated causality or liability, meaning that they've gone to the courts and that this defendant knows they're in trouble. Typically, they're already in the talks about settling. The law firm valuation specialist, which every industry you can do loans against, they have somebody valuing that, and there's law firm valuation specialists that we're working with. He's done over 100 law firms over his career, and so he goes and he says, "Okay, what is the medical records? Does this guy have them? Does he have proof of exposure? Was he harmed? Does he fit this existing lawsuit? Where are these settlements coming in at right now?" And so let me give you an example of one, like Camp Lejeune water contamination. Have you heard of that one?
Yeah,
of course.
So like 17 years of DOJ fed contaminated water to military and civilians and their families at a Marine base. And now there's a law passed that actually says that they're liable for it, right? And that they're responsible, and the U.S. Judgment Fund is now responsible to pay claims, and they've established a grid that says, based on how long you were there and what your disease is, here's how much you could settle for today.
Wow.
Right. So
Yep.
there's a 1,800 military individuals which we have lent towards an attorney. An attorney is representing 1,800 in which we will participate in the settlements, and we're engaging with we're funding the attorney to be able to do representation for these individuals, and that's an example. So that's a pretty easy thing to confirm.
Yeah.
You can go through a list of 1,800 because we do a statistical, or our valuation guide is a statistical sample to make sure all the records are there, proof of exposure. There's a clear grid saying this is what they're entitled to. You put some assumptions in there for, attrition and all this stuff, and you can come up with a really solid. And instead of lending like 80, 90 cents on the dollar, like some like crazy real estate lenders do, we're lending 10, 20, 30, 40%.
Okay.
Amounts. And so it's a lot. Another one, for example, is because there's several like Roundup weed killer where there's been settlements already on that. Paraquat's another one. So we have about 300, I think, we're representing there. We're looking at PFAS, forever chemicals, and firefighter foam right now, where those were said to have been, firefighter was said to have been safe. However, now it's actually caused like horrific deaths, like non-Hodgkin's lymphoma.
Wow.
There's baby formula, which causes devastating problems with heavy metals and toxic ingredients. Then there's those are kind of what you call like a mass tort cases, which are established. It's fairly reasonable to assess what the settlements are. It's pretty easy to see if somebody is a valid claimant for a specific lawsuit. And then you just put in your, your conservative underwriting assumptions, just like you would any deal. And then there's kind of one-off kind of cases where, like I said, we're not going one person against, we may be going against McDonald's Goliath, but we said lots of people. Like right now we have a handful of people in the LA that were affected by the LA Juvenile Detention Center, which notoriously mistreated and didn't protect the people that they were there to care for. And so it's publicly available that they're now reaching settlement. And so that we actually have individuals whom we've advanced funds to an attorney who's doing their representation base, who are going to see settlements from the LA Juvenile Detention Center. There's a couple other prisons and other kinds of institutions, which we're not closing right now, because they're right in the middle of, but that is also examples. The big ones, those are really interesting because they're terrible cases. It breaks my heart reading through and my partner David Gooseman's been doing this for a decade for large institutions. I met him when he was literally, his minimum check size was 20 million, and he was spending $50 million in litigation funding and litigation finance for hedge funds, and he wouldn't take my check because I couldn't aggregate that much money in litigation funding. So he called me like 3 years later. We learned of doing real estate deals together, and say, hey, look, man, I left private equity. Let's set up a fund together. And that's how we took many years begging him, trying to get him in to do it. But he's got a little thicker skin than I do, but the stories are just horrific, right? Of what happened to these individuals. And I think what's really cool is that we're not doing the, hey, I got burnt by a coffee. We're not doing the ambulance, their crap, right? And I think that we're actually doing what I think is really cool work out there. Yeah. And I think that it really does enable access to those who are harmed by, quite honestly, some evil doings by large corporations. And it is affecting the way their calculus by which they make decisions moving forward. Yeah. And it's super clear because mass tort costs, which is a mass harm cost now, tort comes from the word tortum in Latin. It just means harm or unjust justice. And so that's the jargon word, but it just means when one evil defendant harms a lot of people, those costs have exceeded like $500 billion now. So there's a correctional system here where there's like kind of like this evil kind of ambulance stranger, litigious type of America. But then on the other side, Roundup, they literally falsified Monsanto these documents, and they had to read the EPA. Then they lobbied the EPA, and the EPA published those. That's caused tens of thousands of people die horrific deaths. So now they've retracted a lot of that information, this corruption, and so it's actually making a difference long term. Now, that said, this isn't a social impact or ESG focused. In fact, I did a whole mastery series on social impact, but it is actually doing something really cool, right? And just like in our real estate deals where we say we provide a cleaner, safer, and improved living experience for our residents, as well as great recession resilient returns for our investors. I think we're doing something similar in the litigation portfolio as well, because we are in fact providing access to justice through those and going against specific opportunities where we think that there was actually a harm or injustice done.
Yeah. Patrick, a good friend of mine, I met for dinner about 2 weeks ago, is in the medical venture capitalist world, right? And we're, having a banter. And I'm telling her that, to my view, real estate's been in a recession for, 2.5 to 3 years. And as a, mainly real estate focused person, I'm feeling a little bit sorry for myself in the industry that I find myself in. And I asked her about, her exposure to interest rates in the medical world. To your point, they don't factor. It's just not a thing. It doesn't impact the industry whatsoever. And I had pangs of jealousy about it. And so the overriding point of today's podcast is there are other assets out there that you're not going to hear from your financial advisor is not going to tell you, hey, listen, you need to contact Patrick Grimes over at Passive Investing Mastery, and he's got a bunch of funds. But I'm going to list these funds real quick that that you have right here. And if anyone wants to know anything more about them, you have taken a very, very defensive approach to what you've got out there at the moment. And well, you've got 3 funds that you're working with at the moment, which is your recessionary acquisitions fund. And that's basically you're going out there and you're taking advantage of these multifamily assets that are in highly, highly financial distressed states. And you're going in there and you're being able to take out, the debt side and essentially burn the equity and the profit, so there's discounts to be had there. Then you also have your diversified litigation portfolio. Anyone who wants to know more about this, because to your point, it's from settlements in late stage lawsuits. That's amazing. And I'm going to ask you a quick question in a second about that. And then you have your recessionary income fund. Patrick, I have diversified my own personal financial strategy over to the lending side, over to the private lending side myself. So that just correlates that you're lending in the commercial world, I'm lending in the residential world. But this strategy is identical. So you've taken a very defensive approach to, what's happening out there. So anybody looking for income and looking for right size investment opportunities in the marketplace that we find ourselves in, this higher interest rate environment. There's a lot of movement geopolitically, globally, and so on and so forth. So we'll wrap up on this here, Patrick, but just out of curiosity, can you give us the average returns of the litigation portfolio and the average returns of the income fund, just so people can get a sense of that, and then how to get in contact with you, Patrick?
Yeah. So, so the income fund's the real estate asset-backed debt fund. When an operator needs more time and they want a gap or bridge loan, and the banks are on the sidelines with high interest rates. And the acquisitions fund is where we buy things if they don't want more time, but they want out. And as you say, we can buy mostly commercial assets, not office, but retail, industrial, manufacturing, warehousing, that kind of stuff. And so where we can just swoop it up in cash. And it's the best buying opportunity in my life in the commercial lending opportunity. So those are different. One's a growth. Acquisitions is a growth fund in the equity. And then the debt is lower risk cash flow play. And so that's the income fund. And so we actually allow for, which we're allowed to share these. We're allowed to publicly share these returns. We have them on our website. We allow for varying liquidity options in the income fund because we have loans constantly rolling in and out, but we have 90-day, 6 months and 1 year notes, fixed income notes. So you can get out of a bank that's lower returning, and the sun's rising behind me right now.
I
So
say it.
yeah, so we have 7, 8.5, and 10% monthly realized fixed income, and then we have a 3-year lockup, and that gives you kind of a profit sharing of the fund overall, which is usually a 9 or 10% preferred return, and a 50 or 60% split of the profits. And those between different share classes have been somewhere between around that 13.5 to 14.5 since inception, monthly realized annual distributions, or you can reinvest and compound monthly. And so we have most of our investors invest and they just compound monthly. But you think about it, those are like equity-like returns. But in a loan portfolio, the
Yep.
3-year lockup, but a loan portfolio with is at an average of a 59% loan to current value in commercial real estate, not residential, commercial real estate, existing commercial real estate. So it's really cool. We're not doing construction loans or renovation loans where you hope and bet on future, but current value. So it's a really cool, it truly is a recessionary income. It's the opportunity to, we would never do debt when it was only 6, 8%, but now we can lend on those same assets, 12, 13, 14. Acquisition fund, we're swooping those up. And to your point, people have performing assets. They just need out. There's some, maybe this that or another asset where they're troubled, and we can close quick and cash. And that's a growth fund. And we've within the first year, we exceeded our projected 30% annualized returns, and now we're far north of that. And so that is a really cool opportunity for immediate growth in the best buying opportunity in commercial real estate. And so those are opportunistic funds. And then litigation finance, that is a growth play as well. It doesn't, no steady Eddie cash flow inherently. There's no tenant paying rent. It's somebody that needs representation that can afford it. So that is an investment. But because we're in literally thousands of lawsuits over that settle over the course of 3, 5, 7 years, we aim for lawsuits that should settle in that 3, 4, and maybe tapering in year 5. You'll see the majority of your return coming back in the middle. It's not like a real estate deal. People have a hard time. You got to put a different thinking cap on when you get into alternatives, because it's not just one refinance or one sell.
Right.
Imagine a portfolio of thousands of single family homes, all of which are going to be sold, majority in that 3, 4, 5 year range, but there may be some tapering on the back end, right? Because you have settlements coming in, and so it's most of your returns in the middle, and that's really, and it kind of then on the back end is a lesser number. So that's what the diversified litigation portfolio allows you to get, is put some money away into something that is not going to go up and down with the rest of your portfolio, and I think that's what makes that very exciting.
Patrick, to be able to kind of summarize, for the listener that has the rental property where they just had to go through the eviction and now they're seeing the rental rates drop and they're like, maybe I need to potentially look at some other options. To be able to see your diversification, to say, hey, if you want to go with the little bit lower risk, steady Eddie cash flow, you've got that. You've got the more opportunistic options as well too. So it sounds like you've got a lot of great options, because the recession that we're in or we're about to be in or wherever we're at, depending on who you ask, I think that you've got some really good options to offset kind of the riskier stuff right now. If someone is listening to this and they're like, you know what, where do I find out more? What's the best way to reach you? What's the best way to get a hold of this information so that they can contact you and start to understand your world to potentially participate in?
Yeah, so passiveinvestingmastery.com is our website, passiveinvestingmastery.com. And on there, you can set a meeting with me right there. There's scroll down, there's a Calendly link. Love to chat with anybody wherever you're at in your life. I give away a book. I've got a few of them now where I wrote a chapter, and this one was super cool. Lessons from thought leaders, and there's some amazing people in here. Brian Tracy wrote a chapter and did the forward. Phil Collins, lead guitar, Def Leppard, an actual rock star. NFL players. I'm right here. On the bald headed.
There you are.
Still, yeah. So super. I mean, there's a Navy SEAL. I'm probably the only nerd on this. Yeah, the engineer. The only nerd on this cover. But I tell my whole story, how I started in high tech, lost it all, made my way back into a single family, worked towards larger apartments, diversified into energy and legal and other ways. And I talk about why it's important to look at non-correlated assets. And if this helps to inspire anybody along their journey, passiveinvestingmastery.com/book. That's the secret link. Passiveinvestingmastery.com/book. You can download the ebook for free or select ebook and hard copy. I sign them and I send them out for free. And you got to put the name of the podcast. Make sure you put Burn Your Boats Wealth in the promo code. If it's a random and we don't know where you came from, I'm not sending anything. But if you tell us where you came from, then passiveinvestingmastery.com/book. Right on top of our website, you can opt in for information about our affiliate funds. But regardless, set up a call. Let's have a chat. I'd love to. One of the things I love to do in this world is invest back into other people's journeys and get to know more people out there. Especially you guys are in my Chompson ground, like right in California. Like this is where, I was homegrown and baked. I'm in Oahu now, in Honolulu now, but that's where I spent my life. So happy to chat with anybody.
Well, Patrick, the pleasure's been all ours today. I think you really, really right-sized your funds. It's serendipitous to have you on at this time with the stock markets in correction territory and real estate really, really in a bad spot with high prices and high interest rates. And so to have this conversation with somebody, this didn't happen overnight. So you've been thinking about this for a long time, and somebody with your credibility and your educational background, you're obviously very, very clever. And so looking at this, quite frankly, I can see myself putting a little bit of capital into all three of these because they're all right sized for the moment that we're in. I think you could ride out the recession with what you got going on here. So with that being said, Patrick, pleasure's been all ours. I hope to meet you again in real life before long. Hopefully it's in Hawaii. That would be cool.
Yeah.
And but for today, Patrick, thank you so much for getting up so early in the morning. I see the sun rising behind you there, and go out and have a great day. You've already achieved while everyone else is just getting out of their bed right now, you've already popped a great podcast into the world right here. So appreciate your time, Patrick.
Thanks, Patrick.
David, glad to be here. Appreciate you having me on.
Appreciate it. Hey, Patrick, thank you so much, and we'll see you next time.
Thank you so much for tuning into today's episode. Look, we truly appreciate your support and hope you found the conversation insightful and engaging and useful. If you enjoy the show, because there's a lot of shows out there, would you please take a moment to rate and review us on your favorite podcast platform? Your feedback helps us grow and reach more listeners. And if we reach more listeners, we will have bigger and more interesting guests. So don't miss the show. Please go ahead and subscribe so you don't miss the next episode. We hope you enjoyed today's show. Thank you so much.
You've been listening to the Burn Your Boats Wealth podcast with Clark Lunt and David Shaw. We would love to hear from you. Please reach out at contact@burnyourboatswealth.com with comments, questions, and if you have a topic you would like Clark and David to discuss on an upcoming episode. We would very much appreciate it if you took the time to rate and review Burn Your Boats on your favorite podcast listening app, and make sure to follow and share on social media. Content in Burn Your Boats Wealth podcast is for entertainment purposes only and is not legal or financial advice. Please review our legal disclaimer at burnyourboatswealth.com. Thank you and have a great day.